Usually when you look at a wildly successful tech platform, the math is pretty straightforward.
Right. You build the infrastructure, people use it, the value goes up.
Yeah, exactly. It's just a straight line. But like, then you step into the Cosmos ecosystem and that straight line just completely snaps in half.
It really does. It's one of the biggest mysteries in crypto right now.
I mean, we are talking about the Internet of Blockchains here. This technology powers a $45 billion ecosystem of over 115 interconnected chains.
Right. Massive players.
Yeah. You've got Binance Chain, DYDX, Celestia, all built on this architecture. And yet, its native token, ATOM, has plummeted over 90% from its 2021 all-time high of, what is it, $44.70.
Yeah, around there. And now in mid-2026, it's hovering around $1.82.
It is just a fascinating paradox.
Oh, absolutely. The disconnect between the ubiquitous adoption of the technology and, well, the grim reality of the token price is probably the most heavily debated topic in digital assets today.
For sure.
Like, the open source software has unequivocally won the interoperability race, but the asset itself has just bled out for years.
Well, welcome to this deep dive, where we are on a mission for you listening to unpack the real drivers behind ATOM's relentless sell pressure.
Yeah, we're going to dig into the actual numbers today.
Exactly. We're going to decode exclusive 2026 on-chain data that, frankly, shatters some long-held community myths. And we'll explore the massive tokenomics overhaul that's currently attempting to turn ATOM from a bleeding asset into an actual revenue-generating engine.
It's a huge pivot for the network.
Oh, and real quick, for anyone listening who is actively trading right now, please do not confuse the crypto token ATOM with the NASDAQ-listed semiconductor company Atomera.
Oh, man. Yeah, they share the exact same ticker symbol.
Right. ATOM. We are looking at the crypto asset today, even though, honestly, automated trading algorithms are probably making that exact mistake and accidentally buying semiconductor stock as we speak.
It's funny, but the data contamination from that ticker overlap is a genuine headache for institutional tracking systems. But, I mean, it highlights how easily things get misconstrued in this space.
So true. So let's start with the big question. How does a network build a $45 billion ecosystem and capture zero value from it?
Yeah, that's the core issue.
Like, to understand why people are selling ATOM, we first have to understand the historical design flaw that's been holding it back, right?
Exactly. The community calls this the free bridge syndrome. And to really get it, you have to look at the two crown jewels of Cosmos.
Okay.
So you have its consensus engine, Comet BFT, and the Interblockchain Communication Protocol, which everyone just calls IBC.
Right, the famous IBC.
Yeah. So Comet BFT is often described as like military-grade security.
Which sounds cool, but what does that actually mean?
Well, in technical terms, it means Byzantine fault tolerance with instant finality. Basically, even if a full third of the global servers securing the network maliciously coordinate to attack it, or if they just suddenly lose power, the network mathematically guarantees that no transactions will be reversed or corrupted.
Wow.
Okay.
So it is an incredibly resilient foundation.
It is. And then IBC sits on top of that. IBC is basically the universal translator.
Okay, how so?
It allows all these sovereign, completely independent blockchains to lock assets on one chain and cryptographically mint a perfectly backed representation on another chain.
Got it.
And we are talking about serious volume here. Over $134 million transits through IBC every single week.
That is massive.
But here is the catch. Cosmos provides this entire infrastructure completely for free.
Wait, for free?
Totally free. The Cosmos Hub routes all this traffic. It funds the underlying software development kit that developers use to build these chains. And the ATOM token captures absolutely zero of that $134 million in weekly volume.
Okay, let's unpack this with a real-world analogy for you guys listening.
Yeah.
It sounds like Cosmos built the world's most advanced high-speed highway system. Like, they paved the roads, they put up the guardrails, they routed all the traffic, but completely forgot to install any toll booths.
That's a great way to put it.
So everyone is just driving on it for free, but the creators are going broke paying for the asphalt.
That captures the structural flaw perfectly. And, you know, there was a major attempt to build a toll booth back in 2023.
Oh, right, I remember this.
Yeah, they launched a feature called interchain security, or ICS.
They also called it replicated security, right?
Exactly. The concept was that the Cosmos Hub would export its massive battle-tested validator set to secure other smaller chains.
So instead of a new chain having to figure out its own security.
Right. Instead of a new chain, like, say, Neutron, having to bootstrap its own servers and trust network from scratch, they would just rent the Cosmos Hub's security.
Which makes sense.
And in exchange, ATOM stakers would receive yield in the form of those consumer chains' native tokens.
So they were basically renting out the security guards.
Yeah.
That sounds like a perfectly logical way to generate revenue on paper. Why did that work?
Because of the operational reality of running a blockchain, it was just too heavy.
What do you mean?
Well, under replicated security, every single validator on the Cosmos Hub was mandated, legally bound by the protocol to run full dedicated nodes for these new consumer chains.
Oh, wow. So they couldn't opt out.
Nope. And that meant spinning up new servers, increasing storage, dedicating massive bandwidth. And the problem was the financial yields generated by these smaller consumer chains were microscopic.
Ah, I see where this is going.
Yeah, the payouts were nowhere near enough to offset the monthly cloud hosting costs. Validators had to pay AWS just to keep the extra servers online.
So the toll booth literally cost more in electricity and maintenance than it brought in tolls.
Exactly. And furthermore, it created deep technical debt. The ICS code was heavily tangled up in the core consensus code of the Cosmos Hub. So every time they needed to upgrade the main network, developers had to untangle this complex web of consumer chain data.
That sounds like a nightmare.
It was. It made the entire network sluggish and super difficult to maintain, which is why ICS is being completely deprecated in 2 phases right now in 2026.
They're just ripping it out.
Pretty much. The community voted to stop onboarding new chains, and developers are systematically ripping the ICS code out of the hub to optimize the network for speed.
Okay, so if the toll booths failed, the community had to point the finger somewhere to explain the falling token price, right?
Oh, absolutely. Human nature.
And the obvious target was the token's inflation rate.
Yep. The boogeyman of crypto.
Right. The dominant assumption for years was that because validators were being forced to run all these expensive servers we just talked about, they were simply taking their inflationary block rewards and dumping them on the open market.
Just to pay their Amazon Web Services bills. And that narrative, high inflation equating to validator dumping, was accepted as absolute gospel in the ecosystem.
Everyone believed it.
Everyone. It was the only narrative that made intuitive sense to people watching the price slide month after month.
But this is where we get to the core of this deep dive. The brand new 2026 on-chain data completely upends that narrative, doesn't it?
It shatters it.
So the Cosmos Hub commissioned this risk modeling firm called Gauntlet to conduct a massive quantitative study on exactly where the sell pressure was originating.
And Gauntlet is top tier when it comes to this kind of forensic analysis.
Right. And they analyzed 16 weeks of data, basically all of Q1 2026, and tracked over 25.5 million likelihood-weighted ATOM being sold.
And that term likelihood-weighted is vital there.
Why is that?
Because they didn't just guess based on trading volume. Anyone can look at a chart. Gauntlet built a custom classification engine.
Okay.
So if ATOM moved directly into a known centralized exchange deposit address, they assigned it a 0.95 probability of being a sale.
That makes sense.
Right, and if it moved via an IBC transaction with an explicit swap memo attached to it, like stating it was a trade, it was a 1.0 probability.
So they weren't guessing.
Not at all. They meticulously mapped the exact pathways value took to exit the ecosystem.
Okay, but hold on. Because when I was reading the report, when they published the results on validator selling, the number was 0.1%.
Right, 0.1%.
That almost sounds like a typo. How can a network with an inflation rate historically hovering near 10% not see any of that hit the open market?
It's wild, isn't it?
It is. Like, what are validators actually doing with all those newly minted tokens if they aren't selling them to cover costs?
It sounds super counterintuitive, but the data is just clear. Validator commission liquidations accounted for just 31,000 ATOM out of the 25.5 million sold over the quarter.
31,000 out of 25 million.
Exactly. Basically a rounding error. You see, validators in this ecosystem are generally long-term aligned. Many of them are backed by venture capital, or they operate nodes across dozens of other profitable networks, like Ethereum or Solana.
So they use the profits from those chains to subsidize their Cosmos operations.
Precisely. Instead of dumping their ATOM commissions, they are overwhelmingly compounding them.
Just restaking them.
Right, restaking or using them to gain voting power in governance. The fact is, daily inflation simply is not the source of the downward price action.
Okay, here's where it gets really interesting, but also a bit confusing. If the people securing the network aren't the ones driving the price down, who is?
Intense concentration is the culprit. Just 6 holder cohorts account for 92% of all sales.
92%.
Yes. And Gauntlet broke this down into 2 distinct types of selling behavior.
Okay, let's hear them.
First, there is the baseline sell pressure. These are whale addresses, entities holding between 100,000 and 1 million ATOM, and they consistently generate about 30% of the selling pressure week in and week out.
So it's just a steady, institutional-sized drip.
Exactly, a slow bleed from the biggest players.
But what about the other 62%?
The rest is driven by massive, unpredictable episodic bursts.
Episodic bursts. What does that look like on-chain?
Well, for example, the Gauntlet data isolated one specific week where a single whale wallet routed 3.2 million ATOM directly to centralized exchanges.
3.2 million in 1 week.
Just dropped it on the market. And in another instance, they tracked a cohort of mid-tier retail holders who panic sold 85% of their entire 16-week volume in just one single 7-day window.
That is insane. But look, if the real sell pressure on ATOM is coming from these sudden multi-million token whale dumps, then just tweaking the inflation dial down a few percentage points won't actually solve the problem, will it?
Not even a little bit.
Right. You were just punishing the people securing the network while doing absolutely nothing to absorb those massive sell walls.
And the ecosystem is finally recognizing that mathematical reality. To absorb episodic sell pressure of that magnitude, a network doesn't just need lower inflation.
What does it need?
It requires constant structural buy pressure. It needs actual revenue streams that dynamically lock up supply and eat through those whale dumps when they happen.
Which brings us to the aggressive 2026 tokenomics redesign. Since the old ICS toll booths failed, they are fundamentally altering the economic identity of the asset to create those revenue streams, right?
Exactly. They are attempting to transition ATOM from a purely dilutionary model, where stakers are just paid with newly printed tokens, to a fee and revenue sharing architecture.
So what's the first step in that overhaul?
The first pillar is monetary policy. They are narrowing the inflation band from the historical 7 to 10% range down to a really tight 2 to 6% band.
Okay, targeting an equilibrium of around 4% from what I read.
Yep, 4% is the target.
But they are pairing that supply reduction with a new mechanism called lock-based multipliers.
This is a huge change for Cosmos.
Yeah, so basically, if you are a staker and you commit to locking your ATOM in a smart contract for 3, 6, or 12 months, you received 25%, 50%, or even 100% higher yields.
Right. They are heavily incentivizing users to remove their tokens from liquid circulation.
Which directly neutralizes that short-term speculation.
Yeah.
You can't panic sell if your tokens are locked for a year.
Precisely. That removes the liquidity, but the yield have to be funded by something other than inflation, right?
Right. If they're cutting inflation, where's the money coming from?
This is where the new capital allocation engines come into play.
Okay.
Take the ATOM Builder Funding Market, or the ABFM, and the Hydro Inflow Vaults.
Let's start with the ABFM.
So historically, decentralized networks just hand out grants from a community pool.
And we know how that usually goes.
Yeah, it often results in funding vaporware. Teams take a massive grant of tokens, they sell them immediately to fund their operations, which dumps the price, and then they fail to deliver a working product.
But the ABFM seems designed to completely eliminate that dynamic.
It really does. Under the new model, builders submit proposals, the community ranks them, but the funds are locked in secure smart contract escrows.
Oh, so they don't get the money up front.
Exactly. Payments are only released conditionally based on verified milestones, usually in 15 to 20% increments.
And if they don't hit the milestone?
If a development team underperforms or misses a deadline, they get slashed, the funding halts immediately, and the capital is automatically reallocated.
That is brilliant. It protects the treasury from being a source of sell pressure.
It turns the treasury into an asset instead of a liability.
Okay, so that fixes the funding side.
Yeah.
But you mentioned the Hydro Inflow Vaults. That's where the actual yield generation occurs, right?
Yes. Hydro is a native liquidity allocator that migrated to the Cosmos Hub.
Okay.
They run automated vaults that deploy ATOM into decentralized finance opportunities across various chains. And one of their primary strategies is arbitraging liquid staking DPEGs.
Okay, pause. What does arbitraging liquid staking DPEGs actually mean in plain English? Like, what is the financial mechanism driving the returns for you and me?
Fair question. So when you stake your ATOM, you often get a receipt token like Statum or Datum that represents your staked position, right?
Right.
Normally, one Datum should perfectly equal one ATOM, but sometimes during a market panic,
People want to exit immediately.
exactly, people want to sell right now, so they don't want to wait for the 21-day unstaking period. They dump their Datum on a decentralized exchange, causing the price to drop.
Ah, I see.
So the vault sees that Datum is trading at, say, 0.98 Atom.
A discount.
Right. The automated smart contract swoops in, buys the discounted Datum, initiates the 21-day unbonding process, and eventually redeems it for the full 1 Atom.
Capturing a risk-free 2% spread.
Exactly. And by running these automated strategies constantly, 247, the Hydra Atom Vault has been averaging a massive 18.77% annual percentage yield.
Generating nearly 19% yield purely through on-chain arbitrage is just impressive.
It's sustainable, non-inflationary yield.
Right. But honestly, the component of this tokenomics overhaul that stands out the most to me is the enterprise licensing proposal.
Oh, this is the big one. This could change everything.
Because, look, massive traditional finance institutions are currently using the Cosmos SDK to build their private infrastructure.
Huge names.
Yeah. Fidelity is using it. Top 5 global banks are using it. Japan's ProgMap platform, which handles institutional asset tokenization, runs on it.
And they all use this multi-million-dollar tech stack entirely for free.
Which goes right back to the free bridge syndrome.
Right. Meanwhile, enterprise development agencies are charging these banks millions of dollars in consulting and deployment fees to build these networks.
While everyday ATOM holders capture zero of that value.
Exactly. So the new proposal borrows heavily from the open source software playbook of companies like Red Hat.
Okay, how so?
You keep the base code free, but you create a Cosmos enterprise stack that includes long-term engineering support, legal compliance wrappers, and certified audited configurations.
Wait, I gotta ask. If the underlying Cosmos SDK is completely free and licensed under Apache 2.0 open source rules, how on earth do you enforce this?
Right, that's the common pushback.
Like, what is stopping a massive bank from just copying the free code off GitHub and completely ignoring the enterprise license?
Well, a bank can certainly fork the free code, but traditional finance institutions simply cannot operate in a legal gray area. They require service-level agreements, or SLAs.
Because of compliance.
Exactly. When a multi-billion-dollar tokenization platform breaks at 2 a.m., a global bank needs a dedicated engineering team on retainer to fix it immediately.
They can't just post a question on Discord and wait for an answer.
No, they can't. They need certified, audited upgrades that won't break their compliance frameworks. So they are paying for the legal wrapper and the guaranteed support, much like how a massive corporation will pay Red Hat for enterprise Linux rather than just downloading a free version of Ubuntu off the internet.
Right. And the mechanism to acquire that enterprise license is directly tied to the token.
This is the kicker.
Yeah, the proposal forces these development agencies to lock up between 25,000 and 500,000 ATOM per license they issue.
It's a massive supply sink.
It is.
Yeah.
If you scale that up to just, say, 150 enterprise agencies globally,
Right.
that is 15 million ATOM, completely removed from liquid circulation.
Woof, gone from the open market.
And furthermore, a portion of the fiat revenue generated from these support contracts goes directly into dynamically buying back and burning ATOM on the open market.
It completely reframes the asset. It transitions ATOM from a speculative cryptocurrency into something resembling a high-yield certificate of deposit intertwined with a commercial software license.
This sounds amazing.
Let's.
In the realm of decentralized governance, attempting to fundamentally change the economic identity of a token never happens without severe friction.
Never.
And in this case, it sparked a literal civil war.
It got really ugly.
Yeah. To understand the current fragmentation in the community, for you listening, you have to look back at the historical trauma of Proposal 848 in November 2023.
The famous 848.
Right. That was the initial governance proposal to cut the maximum inflation cap down to 10%. And it was one of the most contentious votes in crypto history. It passed by a razor-thin 3% margin.
It was basically a coin toss. And Jae Kwon, one of the original highly influential co-founders of Cosmos, fiercely opposed that inflation cut.
Why was he so against it?
His thesis was that capping inflation compromised the core economic incentives required to keep validators securing the network against state-level attacks.
Security above all else.
Exactly. And the philosophical disagreement over what ATOM should be was so profound that Kwon and his development firm initiated a hard fork of the network.
They just left.
They created a pre-fork incubator called GovDin to draft a new constitution, and ultimately launched an entirely parallel network called Atomone.
Yeah, I was reading Jae Kwon's documentation for Atomone, and it completely flips the Cosmos Hub model on its head.
It really does.
Instead of trying to cram security incentives and transaction fees into a single token, they split it into two entirely different assets.
The dual token model.
Right, so they use a token called Atone, specifically for staking and security, maintaining a massive dynamic inflation rate of 7 to 20% to guarantee validators are just hyper-incentivized.
And then the fees.
They mandate a completely separate token called PHO Time, designated strictly as the network's native fee asset.
It's fascinating. The Atomone fork perfectly illustrates the ideological divide in blockchain design right now.
How so?
Well, one faction believes you must restrict supply, lower inflation, and chase enterprise revenue to capture value for the token.
The Cosmos Hub approach.
Right. But the other faction believes you must prioritize massive inflation to guarantee a fortress of security above all else, separating the fee utility entirely so users aren't squeezed.
But listen, if the actual founders of the network can't even agree on what the token is supposed to be, and are literally splitting the blockchain in half over it, doesn't that fundamentally weaken institutional confidence?
That's the million-dollar question.
Like, why would a major bank or a Fortune 500 company lock up 500,000 tokens to build on a network undergoing a public identity crisis?
Look, execution risk is a massive factor here, and the market is currently pricing that in.
Clearly at $1.82.
Exactly. But institutions building private chains don't necessarily care about the crypto-native governance drama.
They don't care about Twitter fights.
No, they care about the technology's uptime and the legal clarity of the licensing. And the open source SDK remains incredibly robust, regardless of community politics.
That's true. The tech works.
It works flawlessly. However, a divided, fractured community makes coordinating complex network-wide upgrades much more difficult. So the market is basically waiting on the sidelines to see if the Cosmos Hub can actually successfully deploy these new revenue models and lockup mechanics before they reevaluate the token's worth.
Okay, let's bring this all back to the big picture for you listening. We set out to find the real drivers of Atom's relentless sell pressure.
And the data doesn't lie.
It really doesn't. The on-chain data proves that the side pressure isn't coming from the protocol functioning as designed. Validators dumping to pay their server bills is a myth.
Yep, they account for just 0.1% of the selling.
The real pressure comes from whales and institutions moving in massive episodic bursts, dropping millions of tokens at once.
Which crashes the price.
Exactly. And to counter this, Cosmos is tearing down failed experiments like interchain security and pivoting hard. They are moving toward enterprise licensing, native order books, and those lock-based multipliers we discussed.
All to create sustainable structural demand capable of absorbing those whale dumps.
It is a complete structural metamorphosis for the network. And, as Cosmos rolls out its upcoming IBC Eureka upgrade, they are establishing native, trustless connections with massive ecosystems like Ethereum and Solana.
The tech is rapidly cementing itself as the universal TCP/IP of blockchains.
The invisible infrastructure routing value across the internet. But if this massive tokenomics overhaul succeeds, it leaves you with a fascinating question to ponder.
Oh, for sure.
If major global banks and enterprise agencies are legally forced to lock up hundreds of thousands of Atom just to secure commercial software licenses, does Atom eventually stop behaving like a cryptocurrency altogether?
That's the crazy part.
Right. If its primary function becomes gatekeeping access to enterprise SLAs and capturing B2B revenue, does it shed its identity as a volatile speculative coin and just start trading more like a traditional B2B SaaS equity?
If they finally manage to install those toll booths on the highway.
It just might. Thanks for joining us on this deep dive. We'll see you next time.